What if I told you that you could start up a business and grow it for 5 years and effectively pay no taxes the entire time you grew it, and then when you sell it, pay no taxes as well?
I'd say, tell me more.
What are some characteristics of startups, right? What's the first thing they need to do to kind of get their business going?
Well, first of all, they need to have a great product or an idea.
Oh, fuck, the marketing guy. But they need funding, right? The whole 5 years you weren't paying any taxes because there wasn't really any income. And then when you sell it, there's no tax either. That is like...
Hey, everybody. Welcome to another episode of the Next Gen Strategies podcast. I'm taking the intro today. We have a really cool episode where we're going to be covering a lot of different things that a lot of business owners, I feel like, don't know about, or maybe they forget about. So I know I make the joke all the time about tie and taxes and accounting and all those good things, even wore a green money shirt today. But we've got some kind of unique things we want to cover that a lot of business owners or even sometimes employees don't know when it comes to, how you could be really taking advantage of some things with the tax system. And there's roughly 5 different areas we're going to cover today, but very unique and interesting ways in which you can save some money. And I don't want to say, just save some money. Yeah. And I'll let you talk more of that.
Yeah. I kind of came up with this episode based on, strategies business owners are missing out on for taxes. And it's things I'm seeing people not do that I think are really impactful. We're not really going to be getting into track your mileage and do your home office deduction. No, I'm looking at some things that I think are really impactful and long-term beneficial for wealth building and mitigating taxes altogether. And there's some easy ones in here, but there's some more complex ones. But it's just one of those things where it's like I don't know, call it a pet peeve, I guess, of mine, but I'm like, man, I wish people were doing these things because they're really not that hard and they're really valuable.
Yeah. And so as a marketing guy, I'm going to be asking as many questions that come to my head throughout this entire thing, because I know Tyler is chock full of knowledge. And so, I, as a business owner myself, and on behalf of all of you, I'm going to be quizzing them today. So maybe when this thing goes live and, we get the YouTube links and everything out there, drop us some comments in there. That would be really cool. We'll come back, and when this is live, we'll answer them, or,
absolutely.
Maybe you don't want me answering them. Maybe having Tyler answering them.
Well, I'd love to know too. Have you used any of these strategies, or are these new to you?
Right.
And, and I'll put a caveat out here. These types of things, I don't want to, get any CPAs in trouble out there.
Yeah.
Because I think the first thing people might think is, why the heck did my CPA not tell me this? And I just kind of want to put a disclaimer out. You need to see your CPA more often. You need to have a much more involved relationship with them if any of these things you think might apply to you, because having that connection so they're kind of in the know of what's going on is what brings some of these things out. Because it's really hard for a CPA to go through the tax book that's stacked to the ceiling here twice around and offer all these suggestions on a whim to every single person that comes through their door. But when they have kind of an intimate relationship with your business and what's going on, as these things come up, they can offer these suggestions. These are not things you can just walk into a door on April 1st and say, do this. These are things that are a part of long-term planning.
Yeah. And that was part of kind of my hesitation of what I was going to say there at the beginning, because I was going to say, these are some, tax hacks, and I don't want to say that because these aren't gimmicky. These aren't the, go buy 50 buildings and then you're going to write it all off and, rob Uncle Sam and all these things. They're very practical things. And so I think that they're, to what you were saying, they're very practical. They're very intentional. There's ways to, really, it's really you're maximizing your ability to, create value and wealth for yourself, right? At the end of the day.
Yeah. And feel free to bug me with questions as we go. I'm going to try to be as good as I can about, examples and things of that, things I've seen, because I think that'll be more valuable for you guys. And it's not just me rambling off IRS code. So don't tune out yet. This stuff is not going to be that dry.
Absolutely. I promise we'll keep them on. Keep them on track. So let's go. Let's get started. Let's get it going.
So I've kind of structured this to kind of come in softly. The first one, you might be like, duh, Tyler, this is obvious, but trust me, I see this every day. But it's, really missing out on either deductions or business expenses, or recognizing income that you shouldn't have because of poor bookkeeping. Everybody can say you got to have good books, but I mean, you probably know as well as I do, especially if you're doing your own books, like it kind of sits there, and you're like, well, I better get in there and do that. And
what are you talking about? You mean as a business owner or somebody who's responsible for that piece of the business that, you're not supposed to just let some transactions kind of pile up and not reconcile and say, I'll get it tomorrow. I'll get it tomorrow. Oh, I don't remember what that expenditure was because now you're 6 months later.
Yeah,
people do that?
What happens, right? That's what happens. If you go 6 months without doing them and you got a million other things to go through, right? That you got fires to put out everywhere. You jump in there and you're like, let me get through these transactions. And those are income and expenditure items or balance sheet items. That's an important item because it's not an income or expense that are showing up. And if you see check number 705 show up and it's a positive number, you might just slip that into income. And what if it's not income?
Yep.
Same thing, an expense shows up. What if that was, an asset purchase, and then there was income as a result of that too because you got a loan? Like those aren't items. Those aren't income items. Those are balance sheet items that affect your P&L.
Yeah. Go ahead.
Yeah, I was just going to say it's the thing I see the most is those messy books are there's one thing where they're just understating revenue or overstating expenditures. That's a problem. But from a point of saving on taxes, you might be putting down more revenue than you have and putting down less expenditures than you actually have because you're not coding some of those balance sheet items right.
Yeah. And I think, I was making a joke about letting the transactions sit there because I'm actually the last person. I'm actually very, very on top of that. Make sure those transactions and stuff line up. But what I am guilty of is as the business starts to evolve, maybe throughout the year, or you start thinking about how you were originally kind of coding certain transactions or coding expenses, like you may need to evolve that. And so what I'm guilty of is saying, I'm going to go make this change at some point in time, or, I'll make a note to go back and change that at some point in time. What I am guilty of is going 4 months later going, oh gosh, dang it. I never went back and did that. Or I never asked my CPA, like, should we change what we're calling this? Should I be thinking about this a different way? That I am guilty of, where I'm like, I'll get to this eventually. And then you get to the end of a quarter, end of a month, end of the year, and you're like, oh my gosh, I had to go through all this again.
And some, for you guys, just some practical items that I see all the time. Owner's draws showing up as an expense. Not good. Owner contributions to the business showing up as revenue. Definitely not good. You're going to pay taxes on that. And that's not a profit item. Loan proceeds coming into the business, getting recognized as income, not income. The way you categorize your debt payments, if you're putting them all to expense, that's not how that works either. You have principal and interest, and there's some balance sheet items. The list kind of goes on. And that's the first place I go when I look at, financials, is I run over to the balance sheet and see what's all messed up because, that's what happens. It's really hard for someone without, fundamental accounting knowledge to nail all those things. But I'm telling you, it sounds super simple and you may think you got it down, but this is one of the number one areas where business owners miss out.
Yeah.
So that's the first one, kind of easy. The second one I wanted to talk about was, retirement savings. So I did, just from my own experience, I see a lot of lack of retirement savings, especially with business owners. So I ran out to the web to try to get some data on this. And I don't know if you knew this or not, but it's something close to 34% of business owners are not even saving for retirement. And retirement is one of the easiest extra deductions you can get on your tax return. So not only are you saving on taxes, you're also building wealth long-term and actually setting yourself up for sustainability and not have to work until you die. So, that's one item. And then there's such a plethora of retirement options afforded to business owners. There are so many, and it's never too late, because the one I specifically wanted to talk about on here are things called like defined benefit plans. And you can kind of think of that as a pension that you set up for yourself as a business owner. And what's really cool about that is if you've been kicking the can down the road on retirement savings, let's kind of picture this, right? You're a business owner and you say you haven't done a great job of putting money back for retirement. And you're kind of sitting there thinking, well, I'm maybe sell my business. That'll be my retirement. Well, there's other options. Typically speaking, owners of businesses in the later stage of their businesses is when they tend to be the most profitable Most of their debt's paid off. Their business has been around a really long time. Like they're making lots of income then. Well, those defined benefit plans, if you've not done anything before, are really powerful because you can sock away a ton of money into those because they're based on coming up with some sort of pension or annuity for yourself. So if you only have a few years to invest before retirement, they allow you to shovel tons and tons of money into those. And it can be beneficial for taxes as tax deductions. So you could eliminate a huge sum of your income as a business owner in that late stage and get it over into a tax deferred retirement account. And you're helping set up your retirement. Plus you could still have your business sale and all of that. And it's just being very effective on taxes. It's one I don't hear people talk about much. Mm-hmm. And it's one of those where it's like, it's not too late. You can do something.
Right.
And it's a very effective plan. There are a plethora of other options like, just all kinds of just traditional, retirement investments you can do over the long haul that have lower amounts that you can put in annually, but they're still pretty high. Some of them are much higher than what you would see that individuals can just put into 401ks. So if you get on a steady pace of chipping some money into a retirement account, you're saving yourself on taxes. Plus, that long term, like I said earlier, like this is a long play. This is wealth building. This is, setting yourself up for the future.
Yeah, absolutely. And I think that there's a little bit of, at some point in time, like a lot of business owners they're putting everything they got into the business to make that sucker go, right? And so, I think what I'm hearing you say is like, yeah, there's sometimes you got to do that. Like you got to go kind of all chips in the middle of the table. And it's like, absolutely. Yeah, I got to put it in here because I'm hoping to have the residual. But I think what you're also saying is like, once you start to get a little bit more of that equity of the business, there's more of a solid valuation on that to where, if you sold it tomorrow or whatever, like you've got some equity there, but you've also got a little bit of risk mitigated because you've got this little safety net that's been sitting out here. It's been kind of slowly growing. So it just kind of diversifies your portfolio and your ability to obviously, put more money in your pocket instead of Uncle Sam's.
That's where the defined benefit plan makes a ton of sense. Now I'm far from a financial expert for like financial planning and stuff. I'm seeing it on the tax side, but if you're dumping all of your excess cash flow into your business to get it up, like I said, that tends to spell out later stages where the business is as profitable as it'll ever be. And you might have that extra cash flow to really, really sock the money away. And this plan lets you put a lot more away than the limits of other plans.
Sure.
So it's like a perfect lineup there. The next one we're going to get into is the big topic that everybody always talks about, and it's real estate.
Here we go. Buy 10 multifamilies. Let's go.
So we're not gonna talk about buy as many properties as you can, cost segregate them out, take all these massive deductions, get active real estate status and all that fun stuff that you hear about a lot. I really just wanted to talk about real estate as a very high level because I want you to understand why it's very advantageous from a tax perspective. Starting in real estate and kind of building a portfolio has a lot of advantages. And I'm not the one that's going to come on here and say, yeah, you should do that because it's going to wipe out all your tax liabilities going on. Like I'm of the position you need strong, profitable rental properties. You need to be very observant about your debt levels and all that fun stuff. And those can kind of, go against each other. But what I'm talking about is just that simple chipping away at a couple properties opens up a lot of doors for you because you have options.
Is that a pun? Or you
look at that.
A lot of doors. I'm sorry.
But you get a lot of options in terms of how you handle cash flow and their tax effects. And I'll kind of give some examples, right? So like say you buy a $250,000 single family home this year and you get it out in the market and you're breaking even or getting some cash flow. Fantastic. Well, if we zoom down the road 10 years, there's a good chance you're going to have a significant amount of equity in that home. So now you're thinking, okay, I need some cash for something I want to do in my business, or I want to buy another rental property. And what's nice is that you don't have to go and look at that property and sell it and realize your capital gains and pay taxes. You have the opportunity to keep it. And what I like to tell people is that the power of real estate and tax is just to never actually sell your real estate, because you can continuously defer your taxes for as long as you live and then pass that deferral onto your kids as well. So say you're zooming down the road 10 years and you're like, I want to buy another rental property, or I want to invest in another business or in mine. You have some equity in that house. That house is probably worth a little bit more money. You can walk into the bank and say, I would like to refinance this property. And the beauty of that is that when you refi that property, the cash that you pull out is tax-free because it's debt. It's not income. You remember when I was talking about messy books? Debt is not income. So you could use that cash to invest into businesses or into future real estate and not recognize any tax. You're just pulling out equity of that home. Many people know this method. I think it goes by the popular term online of like the Burr method. But it's one of those things that I constantly try to educate people on. And it's one of those things that over time you really build up that equity. Clearly you got to pay attention to your debt load and how much your financing is costing you and stuff, but it gives you options, and we love options. The other item that you have as a possibility too is called a 1031 exchange. So say you don't want to sell the property, but you want to upgrade into like something commercial or a bigger house or something like that. Well, technically you can use a 1031 exchange to sell the property as long as you go buy it or acquire another like kind property, which is another, piece of real estate. So you could get all your equity out of that and move it into something else and not pay any tax. So then that all goes together. You've been doing this for 10, 20, 30 years. You're getting to the point where you want to retire. You want to, not manage these things anymore. Give them to your kids, whatever. Don't give them to your kids yet, right? So there's this other thing where you can continue to defer taxes, right? If you just set yourself up, you go to an attorney and set up, some sort of trust or something like that. I don't give legal advice, but whatever you need to do to figure out your estate, right? You're able to, when you pass away and your assets go to your children, they get what's called a step up in the basis of that property, which means the day of your death, or I think it's 6 months later, they get to say whatever that home's worth is what their basically tax equity is in that home. And they could sell it that day and basically pay no taxes because there's no gain for them. Or they could continue to keep those properties and start depreciating them and do whatever they want. But now you've basically for your entire lifetime not paid any taxes on the value appreciation of your real estate. That's a lot harder. That's one of those things that just, we're zooming out so far, but it's not a short-sighted thing. This is not a hack. This is just a method to increase wealth and be tax efficient at the same time.
Yeah. So though I'm disappointed that we didn't say that we were going to buy 10 multifamilies this year, I think that that's very practical, right? Like, especially for folks, who are trying to kind of dip their toes into those things and understand like, well, what does this look like 10 years, 15, 20, the rest of my life? Like, I think that you're giving some good options in terms of like what that looks like. And again, diversifying the portfolio, figuring out, different ways in which, whether it's in real estate or it's in, stocks or it's in, whatever it is, and just being tax efficient with those things.
Yeah. And I think it's nice to just kind of give out, I don't want to call them trade secrets, but to kind of give away some of the things that are commonly happening that you would not know about unless someone told you. Like the common one you see people do if they own a business is they buy the real estate that's associated with the business, the office, the plant or whatever, and they'll buy that through a separate entity that they own. And that's like the rental entity, and you rent from your business back to that LLC. So now you got a piece of real estate sitting out here that's disconnected from the business. That could be your start, acquiring just where your business is. Because the same thing I told you about over there is you could go watch the value appreciate on your business's property and refi it. Because like, think about this, you could refi your business's property to get cash flow to fund the business, and not pay tax on that, which is nice, so.
And charge yourself more.
Yeah. Careful.
Sorry.
Charge yourself fair market value for the lease agreement. Sir.
See, this is where he's going to rein me back in.
So I don't know if Grant, do you have any thoughts or questions about real estate? I know we're kind of moving quickly, and we're going to get into something that's completely a different topic, but
no, I think this would be a good point. Like, there's just, out of all the stuff you hear in terms of TikTok or podcast or YouTube, like everybody talks about real estate and stuff. And, there's always the, but, with it, right? It's like, but you've got this and this, or, but what was the situation of XYZ? So like, I think there's probably an opportunity here, like for, you folks have been listening to, like, if you've got specific things like you're just curious about, or like you might have read and that you're looking for us to maybe, debunk or give more context to. And I say us, Ty, to give a little bit more context to, like, drop them in the comments, and I'm sure you'll do your best, or we'll do our best. And if we can't answer them, then we know a lot of people in real estate, a lot of developers, a lot of folks who have done this, who've been very successful with it, and who have bumped their heads along the ways and come out on the other side, and some who are still growing. So we can even connect you with them.
Yeah. And CPAs get the rap for being a little bit pessimistic about some of this stuff. It's because they've seen it all and people really trying to cut corners and stuff. You wouldn't be surprised how many people I know that are into real estate and think they have this very fine understanding of what happens. And then if you go look at the tax return, it tells a different story. Like what they think is happening is not exactly what is happening because it's complicated. Mm-hmm. But, so you have to be careful about what you hear from your neighbor or your buddy at church. Go vet that stuff by a professional, because like you can't, like some of the things that are being said are like half truths, right? And there are ways to take advantage and be aggressive in real estate, but there are a lot of things you need to do, and you got to have the capacity to follow things to a T to make sure, like I said, we're thinking long-term here, make sure you're not putting yourself in a compromised position with the IRS, things like that. And that's what a good professional will do. And heed their warning signs of, this takes a lot to, do effectively. Yeah, for sure. That's the real estate piece. And then the other one I want to go into, this one is probably one most people haven't heard of. But I'm going to kind of leave it as an example to you and say, what if I told you that you could start up a business, a little startup company, and grow it for 5 years and effectively pay no taxes the entire time you grew it. And then when you sell it, pay no taxes as well?
I'd say, tell me where.
That sounds like a TikTok hot take, does it not?
There you go.
But actually, this is an incredibly popular tax effective method of growing a business among startups. Specifically a lot of like your tech startups and things like that. So there's this special part of the IRS code in 1202 that talks about being able to basically exclude capital gains on a business sale. And this specifically, when I say capital gain on a business sale, if you own a business and you sell it, the money you make on that is considered a capital gain. If you leverage 1202, I won't get crazy into the details, but it's not something that anybody can do with any other businesses. It's specifically, you need to start a C Corp, and you need to acquire your shares of that C Corp from the actual, C Corp. You can't like buy them off someone else. And you need to hold them for 5 years. And then after 5 years, when you sell your C Corp, you say you get acquired, say you made, $3 million, you can exclude all of that from capital gains tax. And the reason why I said earlier, you may not pay taxes along the whole way is let's just kind of think of this scenario, right, Grant? What are some characteristics of startups, right? So typically you see a startup, what's the first thing they need to do to kind of get their business going?
Yeah. Well, first of all, they need to have a great product or an idea.
Oh, fuck, the marketing guy. But they need funding, right?
There you go.
Yeah. Startups typically, their product is great, but they're probably not selling millions of dollars worth of them day one.
They need some capital to get it going.
Right.
Correct.
So you see these types of startups, if you have it in your mind, right? Most of them that have like investments, they want to be set up as a C Corp because that's what investors want. So you're pouring a bunch of equity into this business as a startup. And that's kind of the money that's fueling the business. All the R&D, all the buying the products, the marketing, all that fun stuff. And there's not really any income. Especially starting out.
Yeah, especially because if you got a new product or service, like some of this is proof of concept, right? Yeah. And sometimes you may be giving it away for free, depending on what it is, right? If it's a technology, if it's a small product, like you might have prototyping to do, like you might be putting things in the market for a decent period of time before you start seeing any type of cash flow back, or like I said, or maybe you get somebody to agree to like a pilot program for a certain amount of time, and then after a certain amount of time, there's an agreement that then they would make the choice to purchase fully. Like your income line could be very, very low. Yeah,
and we're talking about these businesses that just take a lot of capital to get going. I'm not saying that this necessarily would work for like Joe's plumbing shop,
right?
Because C Corps are not super tax efficient if you're making profits, because the corporation has to pay taxes, and then when you get distributions, have to pay taxes too. So there's double taxation. Right. But specifically, if you're starting a business with a plan to sell it after 5 years, and you're trying to run this business up to be profitable at that point, so you're using a lot of capital from investors to get it there. And then you see it all the time. Like somebody will come up with a nice little piece of software, and then a tech giant will come and buy it. right? And they just kind of did their proof of concept and showed, hey, this can be really profitable, and then they get bought. So if all these things combined happen correctly, and there's other rules, so clearly you have to have a professional involved in this, but it's one of these things where it's like, you got to know to start it as a C Corp if you think this is an exit plan for you, because I believe you can basically exclude up to $10 million in capital gain. So if you build this business up and you can get it valuable, you could sell it for $10 million in the whole 5 years. You weren't paying any taxes because there wasn't really any income. And then when you sell it, there's no tax either. That is like insane, if you really think about it in terms of its tax strategy.
Right.
So that's one I don't think a lot of people know about. And I think it's getting more popular to think about some of these businesses that are not just tech businesses. Like if you're trying to buy a business and build it up, like private equity is getting involved in all kinds of businesses now. They're getting involved in accounting firms. They're getting involved in all that, and there is a list of businesses, including accounting firms, that are not eligible for this. But these non-traditional businesses that are not funded in a startup way are starting to happen because you're seeing, private money looking for different avenues to invest. So it's a reasonable possibility that this could apply to you and be something worth pursuing.
So as it stands today, right, we're in January/February of 2025, and why wouldn't I'm going to play devil's advocate, or maybe you tell me why it would not make sense to do a C Corp, right? Because everything you just kind of said was like, well, I don't know. Maybe I'm going to start selling a widget or creating something, and I've got this great product. I don't know. Like, I would take investors if I could find that. Like, why would somebody not want to do that? Like you kind of painted the picture of give me that kind of that other side.
Primarily, if you're looking for angel investors in private equity, a lot of them very much want to see a C Corp just because the structure allows them to invest in it easier. It's a little bit, it makes a little bit more sense from a tax perspective. There's some items like if you're in a partnership, right, and you have an investor that comes in as a partner, if there's an audit of the partnership, that actually allows the IRS to jump into the personal return of the partner. And that doesn't happen for C Corps. C Corps just get the entity gets audited. So like there's some reasons why investors want that shield with the C Corp. So yeah, I would say you want to do it if you think you're going to seek a ton of investors. It's not just like that family and friends or stuff like that. The big downside to it is that it's double taxation. With a partnership or an S Corp or just your plain old sole proprietorship, you're just paying profit on that bottom line. With a C Corp, when you hear about this tax stuff that's going on, like lowering the corporate tax rate, like right now, the corporate tax rate is like 21%. That's a floating number. It's been higher, it's been, lower, but right now it's pretty low. But that means whatever the business itself generated in net profit, 21% is going out the door to taxes. And then as a C Corp owner, if that business pays you out a dividend, you got to recognize that as dividend income and pay tax again. So when you don't want to do a C Corp, not a ton of investors, or something that doesn't make sense for like a partnership. Or if you think that business is going to be pretty profitable right away and you have no plans of exiting or selling it because you're not going to be nearly as tax efficient in that C Corp. You know what I mean? So it's one of those things you have to really consider. You got to know, like in hindsight, I want to build this thing to sell it. Yeah. If you want to go that C Corp route and do this 1202 thing, or, I want to build this big, and it's still the same thing. Like these people doing these startups, and get this private equity and these angel investors, everyone involved wants a multiple exit. Like they want to see this business sell to a competitor or a big dog or go public or something like that. And that's where the C Corp just makes sense because you're trying to pool all this extra money in.
Sure.
So that was a great question. There's a lot more that goes into that, but I think that was helpful. I'm sure you guys have never really heard somebody talk in that depth about it.
Yeah. And next segment, we'll just do all around K1s and what that means. If you're starting to do investing in other businesses, no, I kid, but we
prepare never to file your tax return on time ever again. That's what I'll tell you on that.
If you invest in multiple businesses, there you go. So good.
Yeah. So the last one I'll leave you guys with, another one that seems simple, but just if you really do it right, crazy impactful. It's paying your kids in your small business. Now, there's some rules around this depending on what type of entity you are. I'm not going to get into all that, but just if you think about it, ask your CPA. You can pay your children out of your business. And when I say pay your children, they have to be of the age and of the ability to do real work in your business. Like it has to be legit. If you're going to hear like some random advice that says to hire your baby and use them as like photography and stuff like that. Like, come on, let's get beyond that and say you got a 14-year-old at home and they can shred paper and mail documents and do real work. Or if you're in the trades, like they can do physical labor. Like, quit giving your kid allowance and pay them in your business, because what you're able to do there is, you think about this, when a kid has income, right? If they're going working at McDonald's or whatever, they're not really paying any taxes. If whatever it's being withheld for them from a federal income tax standpoint, if they get any withholdings, it's coming back to them on a refund, because they have a significant standard deduction of like 15 grand a year, right? So think about that. You could pay your kid, if they worked enough for you, 15 grand a year. You're taking that as a deduction on your business. So you're saving yourself tax there. And then your kid is getting this income and is not paying tax on it. Now, do they got maybe some school tax or some, Social Security, FICA taxes? There's and there's some rules about when you may or may not have to pay FICA taxes too. But that's the one piece of this where, clearly it's an effective way to save on taxes for you. You're also their parent. So it's not like you're giving your kid money and they get to go spend $15,000. You're your parent. You have a custodial account for them. You control their money.
You've got some built, people struggle with employee retention. You've got some built-in retention with it. Nah, they can't. I mean, man, it'd be hard for them to quit. No, I'm just kidding.
I would love to see at one point in time your like 9-year-old son doing a fractional CMO call. That would be great.
Probably. Oh, yes.
But I don't see this one very often. Surprisingly, I would think I would see it a lot more, because I'm going to give you the other tidbit to this that I think is the coolest part and just nerds me out. And I want to do this with my kids, right? So as soon as your kid has earned income via W-2 or through this job that you give them, now they have access to IRAs, retirement accounts. So we just talked about how you might have just not been able to figure out how to get retirement savings because you've been trying to put food on the table and grow a business and all that. Well, think about your 14-year-old opening a Roth IRA and putting the maximum right now is $7,000 a year in it. They put $7,000 a year in it, or you help them do that, from 14 to 18, or even to like 21, 22 if they go to college. That's their summer job, right? Can you imagine what that would be worth when they're 65? So I ran some numbers. Granted, clearly I'm not a financial advisor. I don't know what the market's going to do, but you can go out and see, it averages 10%. Yeah. Sure. So what I did is said, okay, if we put $7,000 a year in at 14, 15, 16, 17, and 18 years old, and it grows at 10%, and let's inflation adjust it. We're going to take inflation out of it. So we got real dollars. What do you guys think that's worth when they're 65? If after the day they turn 18, they never put a drop into it ever again. So by the time they're 65, that could be worth more than $1.5 million for their retirement. And that's inflation adjusted. So when I say that, that means like that's $1.5 million less today. That's insane. For what? What is that?
What did you just say?
5 years of 35,000 investment that you were saving taxes on anyhow. Turns into that. And with the odds that they maybe, now that you've set this up for them, they start investing in it too. That's going to even quadruple the number probably if they continue to invest in it. Like it's just like an unbelievable opportunity to really set your kids up and save taxes at the same time.
So this was something that when we talked a little bit about this before we started recording today, this was the one I didn't know about. Yeah. Like I knew that there was some, I had always heard there was maybe a little bit of a tax savings or something if you did this, but like I think this is a really creative and good way for multiple different things. And you kind of just touched on the numbers side of it, right? And how it makes sense to potentially build wealth and those other things. The other part of this is that you could potentially, depending on how transparent you want to be, like you're also kind of teaching somebody at a young age of like the importance of savings and, being very judicious with like how you're spending money and what you're doing and looking out for these things. So like, a lot of opportunities there as well.
Yeah, and you'll like this too. There are actually some special rules for farmers too that make it even more advantageous. I won't get into that now just because I didn't print that out and I don't want to misspeak. But this is one of the most, like this, I think honestly originated out of farmers, because you think about it, every family farm has the kids working on the farm. And there's like less, from my understanding, less compliance requirements even for farmers when they hire their kids, less paperwork and stuff like that. Because you do want to do this legitimately. So that might involve like actually putting them on payroll and doing W-2s and all that fun stuff. But I do think there's some easier requirements for the farmers out there listening, to where, and you may be just figuring that out in your family anyhow. But the reason why I'm saying it's important, because if you make it legitimate, that's what gets them the ability to use these retirement accounts.
Yeah.
So that's where all the value is. We're saving a couple bucks here and there on taxes. Like, it's pretty good, but you're that's why I said when I started this thing, this is long-term plays. This is, wealth management. This is setting your kids up. Like, it's super impactful. And one of those things where you're probably sitting here going, dang, I wish that happened for me when I was that age. I'd be sitting good, You're
going to have some CPAs calling you after this episode.
Right, yelling at me.
Dude, what are you talking about? We don't.
Well, I'll tell you though, is I get people who ask me about this stuff, and 9 times out of 10, they just don't go and follow through with the systematic things you need to do to put it into place. So like, understand that these strategies take a little work on your side. You can't just like roll into a CPA's office and boom, it's done. Like, it takes work from you. But that's why I wanted to give you some items that weren't like, well, make sure you track your mileage from your drive here to the Staples store. Like this is stuff that it's worth your time and effort to do and to think about and strategize on, because it's worth a lot. So
absolutely.
Yeah, that's my take. That's my credit to the other CPAs that are like, yeah, they're going to ask me and then not follow through and think I should have did more. It's a joint effort, guys. You got to work together.
Yeah, I think they're practical, right? And they're the ones you don't hear about all the time. And so hopefully as a result of these different 5 things you shared, that we're hopefully going to have some awesome questions and comments come in, and we'll try to direct them in the right way. And, definitely ask some questions around the real estate one too. Like, I think that's probably the one. I mean, you and I have questions all the time with real estate things. Like, what could we do, and where there's opportunities, and how do we help us understand that? 'Cause that is such an interesting world. Mm-hmm. And so like I said, if you have questions more on that piece too, and that's a piece where I think a lot of people, it's always kind of a hot button thing. Like I said, if we can't answer it, we've got some awesome connections who are very good in that space and different ways. Some on like a commercial standpoint, some on like residential, some of the mix of both. So.
Some of them might say, Tyler's full of crap. You can be much more aggressive. And I go, yeah, I agree. Like, there's ways that there is a ton of advantage, but you just got to be prepared to put the work in. And I will add a disclaimer that none of this was personal tax advice for any of you. I'm going to go back to, really try to get a foundational relationship with your CPA. Talk to them often. It might cost you a little bit more money, but these types of things, we're talking thousands and thousands of dollars. It's worth the cost, and them just having a more rounded understanding of what you got going on, rather than just seeing you for an hour once a year, is how this stuff plays out, and it comes out to your favor.
Absolutely. Well, I think we accomplished 2 important things. One, I think we really nailed down some really unique ways in which, 5 different ways in which folks can really be, tax efficient, things they might forget about. And number 2, and probably most important, I didn't give any tax strategy on this podcast. So that's a win at the end of the day.
You almost committed everyone to jail when you said that they should jack up the rent to themselves. But I caught you there. I
tried. I really tried. He wouldn't let me get away with it. I was going to try to sneak that one in there.
But, that's the thing. Be careful what you hear out there. I don't want anybody going to jail for tax fraud.
Yeah. Me neither. So, all right, everybody. Well, thanks again for joining us. Like I said, comment, share wherever you find podcasts, and let us know what you think. And until next time, see you later. Thanks again for joining us today on the Next Gen Strategies podcast.
Be sure to follow the show on Apple Podcasts, Spotify, or wherever you get your podcasts.
And if you really enjoyed it, give us a share on any of your favorite social media channels.
And don't forget to leave us a review.